some major acquisitions in the last couple of weeks here in the Canadian mortgage space. So we're starting to see consolidation pick up again. There wasn't a ton of this since kind of, I guess, pre-COVID. There was a lot of consolidation that happened in the space.
Like, what is pushing all this? Why are there so many acquisitions right now? What do you think?
My speculation is that, we're past COVID. The rate market is still very high, and maybe that's putting some pressure on these smaller lenders.
Yeah.
Or these larger lenders are being opportunistic right now and thinking that valuations are probably going to rise for some of these mid-range lenders.
You know what it is? I think there's also a divide in sentiment in people's mindsets right now of like, what's about to happen in this country?
Yeah.
Versus like, are we about to have a huge growth spurt?
Yeah.
Or are we about to have are we going to stall out really hard?
Yeah.
Thanks for tuning in to the Canadian Private Lenders Podcast, the show about starting a private lender in Canada, the mortgage industry, and the real estate industry. Your hosts are Neal Andrino and Ryan and Neal. Enjoy.
All right, everybody, welcome back. It's episode 39 of the Canadian Private Lenders Podcast with your hosts, Ryan and Neal. Neal, we're back in the saddle, buddy.
We're back in Nova Scotia in my studio, which is not nearly as nice. Now that I took out the old fridge, I feel better.
We got a little bit more space in here.
Feeling okay. It's getting there. I'm thinking we get one of those fancy LED signs for us.
Class it up a little bit.
Okay.
But now that we're live on the video pretty consistently here, we're speaking of which, we're up on YouTube, or we're going to be up on YouTube. We've got the channel set up. We're going to start layering in our more recent episodes on that, and some of our older ones too that we did through Riverside.
Yeah,
we're going to populate up there. So if anybody's interested in checking out the visual,
our ugly mugs,
looking at our mugs, then go for it. It's under Canadian Private Lenders Podcast on YouTube. So take a peek.
Yeah.
So we got an interesting bit of news for this episode today. We're going to talk about some recent acquisitions in the mortgage lending space. But before that, I wanted to check if you saw the breaking news in Dartmouth this morning.
No, it's not.
Dartmouth Crossing, is finally getting an SLC.
I did. If anyone that's outside of Atlantic, that's breaking news for Atlantic Canada's place to buy booze.
Yeah,
I did see that. I thought it was kind of weird. I don't know. Do we have a grocery store here
in Dartmouth Crossing?
No,
not really. No, an
express store.
Consider that. But I found it weird that there wasn't an NSLC in Nova Scotia Liquor Commission in Dartmouth Crossing, because it's just so busy there now, right? It's just such a logical.
You're doing your shopping there. You might as well.
There's an express one there in that gas station in A&W, but it's very small.
NSLC?
Yeah.
Why?
Up on off Wilkinson or whatever.
This is supposed to be their flagship store too.
It is. Yeah. It's not only a new store; it's going to be their biggest store in Nova Scotia. So they're swinging for the fences. But I like it. I think that'll be a good ad for Dartmouth Crossing.
Yeah, so it makes sense. And I think part of it is they're building about 20,000 apartments in Dartmouth Crossing right now.
Yeah, exactly.
So it's going to be populated. It's going to make sense.
Yeah. There's essentially no residential space there now, but it's going to become a huge residential hub for HRM.
They're probably going to end up having to allocate one of those corners to a grocery store, I think.
Yeah, absolutely.
That'll actually be sweet, because everyone who works here, like ourselves, you can just grab it in here versus digging into your neighborhood store. Yep. You know what I mean?
And I wonder if we'll start to see more office space bleed over into Dartmouth Crossing as well. And for anybody who's not aware, Dartmouth Crossing borders on Burnside, which is the biggest industrial park in Atlantic Canada.
Yeah,
here in Dartmouth.
It's massive now. Yep. It's actually become a huge setup. They've got an additional highway they're building that comes into here. It's going to be. It already is really good.
It is good. Yeah, a lot better than Bears Lake.
Oh, shots fired! Bears Lake, for some reason, it was built first, I think. And they just didn't lay it out properly.
For sure.
And so it's just a gridlock every time you're in there.
And they used to have the biggest liquor store in Nova Scotia, but
not for
long. Yeah, it's rough. The traffic's rough over there.
But so that wasn't the news I was expecting you to bring up. I did see that, but no, you sent me a screenshot from an article recently,
right?
That said rich millennials feel so about stocks.
Right.
Just want to touch on that real quick.
Yeah.
I feel like everyone knows, or at least has heard, this whole concept of the biggest wealth transfer in history is taking place, where baby boomers are passing along $84 trillion down the line. And so a lot of them seem to hold a lot of it in stocks. And now they're saying the nouveau rich like to invest in alt investments like crypto, real estate, and luxury watches.
Mm-hmm.
They said they're souring on stocks and bonds. These investments make up less than 44% of their portfolios, whereas The older generation makes up about 70%. And they're attributing to most of these young millionaires lived through two ugly bear markets in 2000, 2002, and 08 and 09, which are formative ages, which might help their explanation of stock conversion. I'll let you first comment on it, but I don't agree that that's why.
Okay.
But I guess maybe I'll say what I think, but you go ahead.
Yeah. Well, I mean, to clarify here too, I think this was based on like truly like wealthy millennials, right? Like I think the net worth of 3 million plus was where it's classified. Is that
21
right?
to 43 with US 3 million or more.
Right. Okay.
And assets.
So, I mean, I kind of get it with the rise in alternative investments. You know, we operate in an alternative investing class as well with our business, but you know, I love to see the diversification.
Yeah.
What was the split? Did it say how much?
Didn't give the full breakouts. It just said 44% are in stocks versus it used to be 70%.
Used to be 70%. Okay.
Yeah.
So like half.
Almost.
Close to half. So that's significant, right? I think alternative investment should be just that. It should be an alternative investment. It should not represent a large portion of your portfolio. I think any financial advisor would say that.
Yeah.
Again, not financial advice, of course. It's just my own personal opinion. You know, whether that's 10% or 25% of your portfolio, in my opinion, you should still have plenty of exposure to stocks, bonds, and hold some holdings in cash as well, or cash assets.
I agree. Yeah. I think, I don't think it has anything to do with the bear markets. I think it's more of when you're young, you're all fired up and energetic and want to make higher rates of return. You want the riskier things.
Yeah.
Crypto, very risky.
Yeah.
Luxury watches, extremely risky. Alt investments, typically riskier than stocks. And then real estate, also honestly more risky and more sexy. And so these are all sexier, more exciting things. And I think that's an age-based item. Whereas once you get to be, I don't know what boomers classified as, maybe 65 plus now.
Yeah.
You're at a point where you're more interested in a stable, fixed rate of return, simplified, low risk. Like you're not at a point in your life where like, oh, I'm super excited to be managing apartment buildings or having staff or dealing with something that might lose me a ton of money. Like I'm not at a point in my life where I can risk a 20% dip. Like, you know what I mean? I'm not going to wait that out for like 15 years to bring it back.
Right.
I think that's all that is. As the time goes on, I'm already starting to see already people that are in this age bracket that are starting to change their mindset where they're like, yeah, you know what? Instead of buying another property, I'm going to buy something like a bond.
Yeah.
I'm going to keep my properties, but I'm going to start putting my extra cash into these places.
Yeah.
So I think it's more of just an age range. Like I think if they were to look at maybe what boomers had back in the day, I think it would have been probably lower. Or the other thing is I think stock market was fair bit newer when they were in that investment range, millennial type age. And so it was exciting and sexy at that point.
Yeah.
You know what I mean?
I tend to agree with you. I'm not sure it's like a permanent shift in mindset. It's just kind of like what's hot these days. And I mean, I think, you know, investing in real estate has certainly become more popular in the last, you know, call it 5 to 10 years, like clearly, right? And that's probably a long-term trend that's going to remain. Crypto, I'd argue the same thing. Definitely more people are getting into crypto, but should you have 50% of your assets in crypto? You know, probably not.
The last thing I'll say too is real estate has not been sexy until the post 2000s. Yeah, as a boomer, you went through like the 70s and 90s where it got absolutely obliterated.
Totally.
Never made any money. Yep. It's been like a liability on an asset. You're not nearly as keen to be dumping all your dough.
And if you ask Neal, we're heading back into that.
I'm just some of these things. I think that's what happens.
Yeah.
History repeats itself.
For sure.
The nouveau rich.
It easily could happen.
The nouveau rich might lose their interest as they get beat up on some of the like. Are luxury watches really the best storing of wealth?
Yeah.
I don't know.
Yeah, it's interesting that all those get lumped together because, you know, you could probably state that real estate is a much more stable asset than luxury watches and crypto based on the volatility of those classes, right? So
people need one of those things. I'm not say which one it is. Probably not luxury watches. Yeah.
So that's exactly what you're saying.
Yeah.
Good stuff.
All right. So we want to chat about some acquisitions.
Yeah, some major acquisitions in the last couple of weeks here in the Canadian mortgage space. So we're starting to see consolidation pick up again. There wasn't a ton of this since kind of, I guess, pre-COVID. There was a lot of consolidation that happened in the space. Obviously, we still have the big six banks leading the charge here. And one of these, you're continuing to see that here in one of the acquisitions we've seen. Earlier this year, it was an acquisition that happened last year, but it closed this year where the biggest mortgage holder in the country, RBC, purchased HSBC Canada. And, there was a lot of uncertainty whether that would be approved by the regulators at the time. Anyways, they got it to go through, and that's now closed. I think it closed in April. That was a monster acquisition, just, makes the big player RBC even bigger in the space. So what we're seeing now is a couple, smaller to mid-range players making some big acquisitions to try to keep up. So
why HSBC sold, I
don't think it was
a large
their
international
core
bank
business, right? So, they're based in London, right? So that's where the core business is, whereas HSBC Canada kind of operated on its own. And they were successful because of their... Did we talk about HSBC on past podcasts?
Not much. It's not ringing a bell for me.
Because they kind of won by being like a loss leader with pricing, right? They always had the cheapest pricing in the market.
Okay.
So, people in the broker space and the mortgage space in general liked having them there because they put pressure on the other banks to lower their rates. And that's why a lot of the concern with RBC acquiring them, and that they're unlikely to be continuing using that loss leader pricing, right? That's, 10 beeps cheaper than the rest of the market.
Interesting. Yeah. I always saw them as the international bank. And I feel like Canada is such a melting pot and such a huge immigration country that they would do well.
Yeah.
But I guess, again, it's also just, they're probably so small here compared to their other branches, like you said, in Europe or in the States.
Yeah. I think they were declining in terms of market share and assets in Canada. I don't have the numbers to back that up, but I think that's what I'd read in the past.
Actually, and RBC too, I feel like has done a ton of push on taking on immigrants. I feel like I see ads for RBC. Like you get into the airports and they get the billboards and they're like, "Hey, do you want to set up a bank account?" And blah blah blah. And I know I had some new to Canada clients, and RBC would approve them based on credit overseas and look at their banking systems from overseas, get them all approved. They were always the best for new to Canada. So maybe that's kind of the play there. But
why don't you take us through the first acquisition that happened about 2 weeks ago, Neal?
Yeah, so that's Nesto. I wasn't familiar with Nesto, but Nesto acquires CMLS. I know them.
Yep.
So Nesto is a Montreal-based online mortgage lender. It's 5 years old.
Yep.
So it's startup. And they were the first lender in Canada to offer 150-day rate holds.
Yep.
Did they hold that through COVID?
I think so. They basically, it's essentially brand new, right? Like only 5 years old in the mortgage space here. So pretty cool to see this. They're exclusively online, like you mentioned, a digital mortgage lender.
Yeah.
Everything they do is through their online platform.
1% cash back on all mortgages. That's an exciting.
Yeah, exactly. And all of their professionals are licensed mortgage professionals and mortgage brokers inside of their system as well.
Okay.
It's kind of behind the scenes there. So
looking at CMLS, they were the third largest mortgage finance company. Wow. Leading provider of capital solutions for property owners, developers, and real estate investors. They had $38 billion under management. Mm-hmm. That's commercial and res. That's insane. I feel like this is almost legitimizing.
Yeah.
Nesto. Because I feel like Nesto's the startup, 5 years old. They definitely had a bunch of capital that was fundraised to get them started.
Yep.
They're doing things that no one's ever done before. It's cash back on mortgages, fully online. And now now we're also buying some.
They're cutting into the space. It's a big move. It's a big move. And, to your point, Neal, this brings them to $60 billion in assets. So CMLS was actually bigger than them in assets.
Yeah.
Before this acquisition,
more than doubled.
Right? So more than doubled. And just to go back to the fact you pointed out, the third largest mortgage finance company, that implies that they're a non-bank mortgage lender.
Got it.
As a mortgage finance company. And that could encompass anything from people who focus on just mortgage lending, like used to be classified as monoline lenders, or even mix as well, or alternative lenders in that space as well that are not classified as banks.
Got it. Were they doing all in-house? You just went direct to Nesto and they did it in-house?
I believe so. Yeah.
Okay.
Yeah.
So basically they were saying instead of paying the 1% broker fee, they were just giving it to you because you were passing it on technically.
Yeah.
Okay.
Yeah,
wow.
Exactly.
Very cool.
Yeah. That's my understanding at least. So, and Nesto is based in Montreal. And CMLS obviously has a presence across the country with, across residential and commercial. So, as you mentioned, they're also the third largest mortgage finance company, and they are a leading provider of capital solutions for property owners, developers, and real estate investors. So truly on that, maybe not classified as alternative lender, but focusing on the development and the commercial side of things.
How did CMLS's rates stack up against? Were they competitive in the rate environment?
Yeah. On the A side, I believe so. Don't know that for a fact, but I believe they're competitive there.
That's crazy. If you're 5 years into the game now, Nesto, and you have $60 billion under management or administration, I guess.
Yep.
Like TD's been around for how long?
Right.
They're everywhere. They have these branches and they're at 285 billion.
Yep.
So you're already 1/5 of them.
Yep.
Like that is wild.
And RBC, it was tough to find data on this. Like I found a lot of data that was 10 years old on the banks in terms of their market share and total mortgage holdings.
Yeah.
RBC was listed, I think, a year ago at 300 billion, and that was probably before the HSBC acquisition. And they're the biggest player in the mortgage space in Canada.
Interesting.
Yeah.
Love to know what they paid.
Yeah, exactly. Yeah, I was kind of surprised. There was no financial terms disclosed on this transaction. But a week later, there was another big acquisition in the space. So,
Jeez.
and this is one from one of the big players. I'd say they're probably number 5 or 6 in the mortgage space, but this National Bank acquiring Canadian Western Bank or CWB, who also owns or operates Optimum Mortgage as well, which we have locally here in Atlantic Canada, but primarily a Western Canadian lender. So do you want to take us through the terms of this one?
Yeah. So National bought CBB for $5 billion. Doesn't close until next year. And the loan book is this the loan book that they assumed was $37 billion?
I believe so, yeah.
Okay. So they added 37
So
billion.
about the same size as CMLS was Canadian Western Bank.
Okay.
Yeah.
It's interesting to know. And maybe I wonder what the price would be in comparison. And so National, they're based in Montreal, they're looking to expand west, and that makes sense because CWB, Canadian Western Bank, is predominantly in Alberta and BC. So additionally, again, another big acquisition makes them quite a bit more national. What is pushing all this? Why are there so many acquisitions right now? What do you think?
I don't know. My speculation is that, we're past COVID at this point. Things have settled down. The rate market is still very high, and maybe that's putting some pressure on these smaller lenders.
Yeah.
Or these larger lenders are being opportunistic right now and thinking that valuations are probably going to rise for some of these mid-range lenders. Also, you could argue both CMLS and Canadian Western Bank for certain play in the alternative space where margins are bigger, right? So it could be a play there where, on top of volume, that they're actually expanding their margin for their business as well.
Yeah, we've talked about this a few times where we expect kind of that private space to continue to grow and become more and more like the alternative solutions are becoming more and more prevalent in today's lending environment because it's so difficult to improve where the way things are here in Canada.
Except when the big six just keep eating up all the smaller players.
Yeah.
Just to stay on top, right?
I wonder what's going to happen. It's interesting. I guess in some ways, I guess it's good, but it's also nerve-wracking, like you said, because you're moving smaller players, which eliminates competition.
Yeah.
Eliminates options. Because what ends up happening, I've even thinking this, I'm like, okay, like RBC, like you said, ate up HSBC.
Mm-hmm.
That undercutting is probably going to be gone.
Yeah.
Nesto acquiring CMOS, I feel like is maybe the opposite, where Nesto's like the startup and they're the ones offering cash back. So maybe they're going to be able to be more aggressive. But I find anytime these companies seem to get bigger, more rules come into play, more scrutiny gets involved, and they start offering less and less programs. They just reduce risk as much as humanly possible. Yeah. Because again, they're no longer in startup phase where they're willing to take on a higher level of risk to increase returns. Yeah. They're now like, okay, let's reduce risk and just stabilize return.
Yeah. And obviously both of these acquisitions are pending regulatory approval, which likely won't happen until 2025. I know the CWB National Bank one is not supposed to close until the end of 2025. But given the HSBC RBC acquisition has already gone through, I can't see a scenario where either one of these doesn't get regulatory approval. Yeah. Right?
Yeah. No, I don't see that happening. It's interesting. I'm just like, I wonder what's happening on the smaller side. Probably there's a bunch that are also going on, like small mix and stuff that are acquiring other ones, like consolidating Ontario. Because again, there's so many. Yeah. But yeah, I guess I think there's what it is? I think there's also a divide in sentiment in people's mindsets right now of like, what's about to happen in this country? Yeah. Versus like, are we about to have a huge growth spurt? Yeah. Or are we about to have, are we going to stall out really hard? Yeah.
But I think that kind of tells you too that lenders likely see this as there's not a doom and gloom scenario coming. Yeah. Where at the worst case scenario is we've got flat prices for the next 5-10 years, right? Yeah. Versus like, it feels like a lot of the analysts are pointing to, and people you hear about in the space saying, the Ontario pain, the worst of it is over, right? The biggest market in Canada. There's been some markets down 15, 20%, right? And you're seeing that sort of start to bounce back.
Yeah. I got to throw some negativity in there because that's what I do. I agree with it. I think it was Daniel Caleb Welch, he's the beast. I feel like
He is
he's the GOAT. Everyone knows
Number
him for
one.
everything.
number one real estate influencer in Canada by a mile.
Yeah. Red Pill Rick, he posted a tweet from this guy, or an X, whatever the hell they're called now. And it was inflation projections.
Mhm.
And basically they're all going up. There's no, did you see that?
I saw it, but I didn't go into it in depth.
I didn't go into it crazy in depth, but if you look at June, the base effect alone will push inflation over 3%. I don't know. That's my only thing. I'm like,
The base effect of the rate decrease?
Yeah.
Is that what it was? Okay.
Yeah.
So it seems like we're not going to get a rate decrease in July. This will probably be not come out until after the rate announcement in July anyways, but we're recording late June.
yeah, I don't know. This is just me just throwing some smoke out there for people to think about. I know I have someone who's in an import business, and they said the cost of importing goods is going through the roof, partially on dollar and partially on shipping costs.
Yeah.
So
maybe we're just going to have several more years of volatility where it's uncertain. But I don't think you're going to see the Bank of Canada push rates back up again after just cutting them. That would be pretty crazy.
I don't know what's going to happen. But anyways, I won't go down that path again.
Yeah. I think we've covered this.
We've been on that a few times.
Yeah, for sure. We'll do that in a future episode again.
100%. So
Good to go?
yeah, yes sir.
Awesome. Thanks everybody for listening.
Sure one. Bye.
Hey guys, it's Neal Andrino, your co-host and your co-founder at Keystone Capital and Director of Investor Relations. I'm also a real estate agent, real estate investor, and business owner.
And your co-host here, Ryan and Neal. I'm the co-founder and president of Keystone Capital Group. Keystone Capital Group is licensed under the Mortgage Regulations Act of Nova Scotia, license number 3000549, and through FCMB, license number 88799. And keep in mind, the views of this podcast are for informational purposes only and is not financial advice.